In this video, we're going to focus on learning what the terms debit and credit mean and how we can use them to clarify whether an account balance is increasing or decreasing. This information is contained in Part 6 of the unit outline. I'm only covering a small part of the information here, but this is the part I really want you to know. You see up at the top here, once again, our accounting equation. Above the accounting equation, I've written debits equals credits. If you write this on top of your piece of paper or on the side, anytime you're trying to decide whether something should be debited or credited in an accounting problem, this will provide the answer for you. This little device here is an English to accounting translator. A couple of things you need to know. Debit and credit have very specific meanings in accounting, but their meaning depends on the particular circumstance. There's no good or bad attached to either one of these terms. When we did our transaction analysis in the equation, our rule was every transaction had to balance across the equation. The increase or decrease to one side of the equation, the left side, had to equal the increase or decrease to the right-hand side of the equation. In debit and credit terminology, it's a little bit simpler. In every transaction, total debits will equal total credits. We define the terms like this. Written above the equation is debits equals credits. This is useful for many different purposes. For one thing, this tells you what we call it when we increase these types of accounts. So anytime you increase an account on the asset side, you would call that a debit. You would say, if you're increasing cash, you would say, I'm debiting cash. If you increase a liability or equity account, you would say, I'm crediting liabilities, or I'm crediting contributed capital or some retained earnings account. So this is the increase rule. It tells you how to increase the accounts that are underneath. This also reminds you that in every transaction, debits equal credits. It also reminds you that if you're ever doing T accounts, and that won't be necessary for this account, but if you ever are, debits are on the left-hand side of the account and credits are on the right-hand side of the account. This is also the normal balance rule. If asset accounts have a positive balance, we would call that a debit balance. If liabilities and equity accounts have a positive balance, we would call that a credit balance. Let's go back to the increase rule. So I said a moment ago that if you wanted to increase an asset, we'd call it a debit. What if you wanted to decrease an asset? Well, the decrease rule is just the opposite of the increase rule. So remember, this is the increase rule, and if you're going to decrease an account, it's just the opposite of what we have up here. Now remember that we record several different types of things under the retained earnings account in equity. Revenues, expenses, and dividends all affect equity. When we record revenue, it increases retained earnings, so that means a credit would be the normal balance for a revenue account. We credit the revenue account to increase it. When we record an expense, it decreases retained earnings. Since we're decreasing retained earnings, that would take a debit. Remember that to decrease an equity account, it's the opposite of the increase rule, so it would be a debit. Therefore, the normal balance for an expense account is a debit. Similarly, dividends decrease equity, so the normal balance for a dividends account is a debit. So under equity here, these are the normal balances for these sub-accounts. Because expenses and dividends decrease equity, they have normal debit balances instead of credit balances. Let's do a simple example. Here I've gone back to Tax Services Company in the transaction analysis that we did together in the last video. We can look at each transaction and use this little translation device down here to convert the work we did in the accounting equation to more formal debit-credit terminology. In transaction 1, cash increased by $10,000 and equity increased by $10,000. Our translator tells us that if we're increasing an asset account, we'd call that a debit. If we're increasing a liability account, we'd call that a credit. So if we were doing a journal entry, we would say we debited cash and we credited equity. Similarly, down here, we would debit supplies and credit accounts payable. Let's take a look at one where we decreased an account. In transaction number 3, cash decreased $900 and retained earnings decreased for rent expense by $900. If you decrease an asset, we'll call that a credit, and when you decrease equity, we would call that a debit, because remember, decreases are the opposites of this increase rule. When we debit rent expense, we're actually increasing the rent expense account because it has a normal debit balance, but expenses decrease equity, so we're decreasing equity. That's where increase and decrease can get a little bit confusing. If you say debit rent expense, you know you are increasing the rent expense account. It's a debit to us in the accounting equation because it's decreasing this category of the balance sheet called equity. In transaction 4, we would debit $800 to cash, we're increasing an asset. We would debit $1,200 to accounts receivable, we're increasing an asset. And the other side of that transaction is an increase to equity. That would be a credit. If we wrote this out in journal form, it would be very obvious that the sum of our debits equaled the sum of our credits, and we'd know our journal entry was also balanced. In this last transaction, decrease assets with a credit, decrease equity with a debit. Dividends have a normal debit balance. And there's that last entry. My advice is if you need to use debits and credits, or you want to use debits and credits, keep this little translator nearby and it'll keep you straight every time.